Welcome back. Well, Melbourne Cup Tuesday came and went without a rate cut from the RBA, and the market is now putting the odds for a cut in February at about 40%.
Coming up shortly, though, the government's mid-year economic outlook, and it is hell-bent on delivering that long-promised surplus. Will that do enough for business confidence that the last three cuts have not?
Well, joining us live from his base in Hobart is top economist Saul Eslake. Saul, nice to see you there. Now, tell us, do you think there will be a rate cut in February?
I think that's more likely than not, based most recently on the Reserve Bank's outlook that was spelled out in the statement on monetary policy released on Friday. And clearly, while the Reserve Bank thinks it's done enough for now with the 3 rate cuts over the past 4 months, it has an easing bias. It's forecasting below trend growth for at least another 18 months, inflation below the bottom end of the Reserve Bank's target band for the best part of another 2 years, and unemployment clearly above its revised estimate of full employment, so it stands ready to ease further if there aren't more confirmatory signs of what the Reserve Bank governor has taken to calling a gentle turning point in the economy. And there are still plenty of downside risks out there, so I think the odds favour a further movement in interest rates in February. But as the Reserve Bank also said, with each additional rate cut, we're getting closer to the point where the scope for conventional monetary policy moves is becoming exhausted.
Right. Now, what do you make of the Treasurer, Josh Frydenbergs, this week doing a bit of a backstep, I think, because he was going to put a lot of pressure on the Reserve Bank to continue to lower interest rates and look at that 2 to 3% inflation band. He appears to now no longer want to pressure Phil Lowe like that. How significant is this?
Well, I think in the end, the Treasurer made the right decision to leave the Reserve Bank's target unchanged at the long-standing 2 to 3% on average over the course of the cycle. To have changed it, I think, would have sent the wrong signals about the relationship between the government and the Reserve Bank. The Reserve Bank are not inflation nutters, as they themselves have said. They've always interpreted the inflation target flexibly, unlike some other central banks in other countries at different points in the past. So, as I say, I think in the end the Treasurer made the right decision. The government obviously is keen to maintain its path towards a budget surplus in 2020-21, or sorry, in 2019-20, and I think we'll see further evidence of that when the mid-year economic and fiscal outlook is released next month. They'd prefer that the heavy lifting, as it were, continue to be done by the Reserve Bank, but as the Reserve Bank points out, there isn't a lot more room for further reductions in official interest rates. And as not only the Reserve Bank, but credible international agencies like the IMF and the OECD have been saying for some time, in these circumstances where conventional monetary policy is less effective and there's less room for it, governments with fiscal space, that is room to manoeuvre on the fiscal policy side, of which Australia is clearly one, should do so if the need arises. And if the outlook continues to be for below trend growth and below target inflation, then I think there is some potential for fiscal policy to come into play.
So you seem to be saying, Saul, that you would like to see a stimulus package rather than a commitment to ongoing surpluses. What shape would that take, in your opinion?
Well, I'm not expecting the government to foreshadow a fiscal stimulus package of any significance in the forthcoming mid-year economic and fiscal outlook. It's rather that I think they should be behind the scenes thinking about what they might do in the event that growth in economic activity and the outlook for inflation fails to meet the forecasts that the Reserve Bank laid out on Friday and that the government will be laying out next month, because there isn't much more that monetary policy can do, at least conventionally, in order to aid that task. And I, for one, have reservations about how effective, in the Australian context, some of the unorthodox monetary policy measures that have been pursued in overseas countries might be here. So in those circumstances, I think attention will shift to the potential for example, bringing forward some of the tax cuts that the government is scheduled to begin in 2022 and again in 2024, perhaps bringing forward some infrastructure infrastructure spending or considering other ways of injecting cash into the economy. That's one reason, for example, why I have no particular concerns about the impact on the budget bottom line of the measures the government announced in the past week to assist farmers struggling with drought and the communities on which they depend in regional areas of Australia. That will provide some direct cash inflows to a part of the economy that, again, as the Reserve Bank mentioned in its Friday statement, is one of the factors weighing on economic growth and particularly on household spending.
Okay, Saul, talking about some of those monetary policy or unconventional monetary policy levers globally, quantitative easing has been used. Do you think the Reserve Bank should be looking at quantitative easing in Australia, or do you think it's a step too far?
Well, there's no doubt that they've been thinking about how they might use measures that have been trialled overseas. In the Australian context, I don't think buying government bonds, as central banks in America, Europe, Japan and elsewhere have been doing, would have much impact. That's partly because if you exclude government bonds held by foreigners, which is more than half the total, bonds held by banks, which they need to do for regulatory and liquidity purposes, and bonds already held by the Reserve Bank, there actually isn't a lot out there that the Reserve Bank could buy. Moreover, unlike the United States and Europe, there isn't a lot of borrowing done by households or businesses at long-term interest rates. So getting long-term interest rates down even further probably wouldn't do anything to stimulate additional borrowing and spending. If we look at negative interest rates as an alternative that's been used in Japan and Europe, to the extent that that works at all, it works in part by discouraging banks from holding large deposits at the central bank and instead encouraging them to lend them out. Well, in Australia, banks don't hold large amounts on deposit with the central bank, so I don't think that would work. It's been suggested that the Reserve Bank buying mortgage-backed securities could be effective in bringing down housing, the cost of housing finance. And there may be something in that, and that's no doubt an option that
Saul,
the Reserve Bank is thinking about.
Just to interrupt you, a direct stimulus, one of the worries appears to be with this property market, which is coming back, that either people will be encouraged to go into the property market as well, which given high debt levels might be concerning, or just get ahead of their payments rather than spend out there in the economy.
And they're all legitimate concerns, which is part of the reason why many people, myself included, think that monetary policy isn't going to be as effective in achieving the objectives of stronger economic growth, lower unemployment and inflation coming back to within the 2 to 3% target band. And in those circumstances, you ask yourself, well, what other options could be on the table? And the most obvious one of those is fiscal policy if we find ourselves in the circumstances where other things need to be given consideration.